Twice a day. I am Craig Fuller here with Julie Vandekamp. We are on a Tuesday roll. We've got so much to talk about. We're going to get into really the economic cycle, what's happening with the economy, really dive into it. We're going to talk about freight and what happens when those running guards fails with RXO's Chief Strategy Officer. Talk about LTL consolidation, truckload consolidation, really something that is top of mind as capacity tightens. And we're going to get into the auto transportation business with Cox Automotive, central dispatch operations. So, Julie, when I look at all of these stories that we keep reporting at FreightWaves, the ones that keep breaking the site in terms of traffic are all this fraud. I mean, every day there's just so much happening in terms of these fraud stories.
Yeah, and I feel like every day it's a new angle. We certainly talked yesterday about the brazenness and the violence. That
one was, by the way, that one is absolutely made for Hollywood. Like the fact that
the bumps, the
bump, these drivers. There's still a question that isn't clear to me on whether the drivers were in on it or did they kind of get rerouted. I don't know that I understand exactly whether or not they. That wasn't clear to me. I took it away that you could argue that maybe they weren't, but who knows? We'll have to research that. But the other thing is like just all of this back-to-back fraud.
Yeah, and new angles, right? Whether it's some sort of embezzlement or money scheme, or we'll hear about in the headlines today, organized crime that Armenian authorities got involved in to help shut down. But it is crazy the level of organization, right? That it goes from just super brazen and violent, like just showing up with a gun and stealing the freight, to also incredibly organized, turning the money that they got from the stolen goods into crypto, like to try to cover their tracks.
There's a lot of organized crime. There's also a lot of unorganized crime in our space, but this space is so attractive for criminals of all sorts of flavors because it's such a big industry. It's so critical to the economy. It's so fragmented. And frankly, law enforcement doesn't have the resources to deal with the issues that keep popping up. And I think that's the thing that we keep talking about is the fact that law enforcement, a lot of this stuff is organized from overseas. It is the responsibility of the FBI to deal with it, but they are so overwhelmed in terms of caseload. And frankly, if it's not big enough and it's not sexy enough, it just doesn't get the attention.
Yeah, it feels like it is lacking a coordinated effort.
Well, that's what Corca is supposed to respond to, and that's what Corca is built to do. It's a congressional rule. It's a congressional law that a bill that is in Congress that they need to pass. And if they do, I think we'll get the resources and cross-agency coordination that it will take. Let's get into headlines.
We kick things off with a strategic bet on the orchestration layer as national parcel carriers continue to shed unprofitable volume. Last-mile delivery technology company Burke is wagering that enterprise retailers will pay for orchestration software that sits above the growing bench of regional carriers, third-party logistics cross-dock networks, gig courier platforms, and private fleets. FreightWaves reported in July that carrier diversification is eroding the last-mile delivery duopoly, with 55% of retailers now using carriers outside FedEx, UPS, and the U.S. Postal Service, and more than a third actively moving volume away from the two national giants. In one example, home goods brand Caraway cut total parcel costs 20% after its 3PL began shopping every order across a network of regional and national carriers. Alternative carriers moved 2.6 billion parcels last year, up 13%, while UPS and USPS volumes each fell 8.3%. Meanwhile, a messy legal battle in the air cargo sector has officially come to an end. Miami-based charter operator Global Crossing Airlines has dismissed its breach of contract lawsuit against Ascent Global Logistics, its one-time largest shareholder, and terminated their exclusive brokerage agreement. Global X had sued Ascent on June 4th for $30 million in damages, alleging the former investment partner failed to honor an agreement to steer air cargo business its way, and instead assigned charter work to its own USA Jet Airlines subsidiary. The companies announced last week they have ended their 2023 exclusive brokerage agreement, with Global X agreeing to payment terms for amounts owed to Ascent. During the second quarter ended June 30th, GlobalX's cargo revenue dropped $2.9 million, or about 50% year over year, and the cargo business is currently taking about $1 million per month from the bottom line. Finally, Armenian authorities have busted an organized freight fraud operation targeting American carriers from thousands of miles away. Cyber police in Armenia raided commercial space inside a Yerevan hotel on July 23rd, where suspects allegedly posed as employees of American freight carriers, redirected shipments, sold the goods, and converted proceeds into crypto assets. The Armenian Interior Ministry announced the operation on August 14th, stating that officers from the Criminal Police Cybercrime Department worked alongside the country's investigative committee, conducting a surprise search following an extensive intelligence investigation. The suspects allegedly used specialized computer equipment and software inside the hotel to gain trust from businesses, arranging transportation services, then moved those shipments to different locations instead of completing the intended deliveries. Armenian investigators continue working with unidentified U.S. law enforcement agencies, seeking additional evidence about the organization's methods and searching for similar groups operating within Armenia.
You know, Julie, like we were saying earlier in the show, is that these organized crime, Armenian organized criminals have figured out how to penetrate the U.S. supply chain and freight movement, effectively rerouting freight, which double brokering is sort of the classic rule. But, we've also heard situations of drivers pick up the load. It's not really a brokering situation, but the drivers pick up the load and then get rerouted. I mean, that was a normal practice in my day, is that we would contact the driver and be like, the appointment changed. And I understand that happens. And it's probably different when, say, U.S. Express or Knight Swift or Warner's dispatcher makes the change. But how do you deal with that if you're a smaller carrier and you get notified?
How does the driver deal with it?
Yeah,
unless it's the dispatcher who they're used to speaking to. That's the only way I feel like around it, right? If it's the dispatcher who they know and they're speaking to, could it be a fake AI voice?
Spoof the number. It's just a scary situation because who knows where this all goes, right? And AI is going to make it so much easier to pretend to be someone, to impersonate someone, to have information about the shipment. And a lot of times, it's organized crime, but there's also inside jobs. I mean, that was the normal thing back in my day, is when you had a big crime, it was sort of there was an insider inside the business that was sort of tipping off. I don't even know if that's required anymore.
I mean, and think about how easy it is now, smaller carriers, if they don't have EDI, if they're doing that, to email a load confirmation. If you're not using some sort of fraud prevention software or service, how easy is it to change a PDF now when you change so you send the load con for the carrier to pick it up, and somewhere along the way it gets intercepted and changed?
Well, I remember we did a story not too long ago where in transit electronic loads, the drivers were pulling over, and they were pulling a pallet or two off of it, skimming it. Obviously, it's got to be worth that. I mean, you're not going to do that for bottled water, but you would do it for electronics. And then doctoring the freight bills. So you replace
you didn't get
it.
an OSB,
and you never took off and so the crazy thing is they don't take off the seal. They actually unscrew the doors entirely. And then they put the doors back on the trailer, and the receiver never has any knowledge about what has happened. I mean, it goes back to what we talked about. By the way, shout out to our sponsor, Samsara, because they've got this tracking label that if you are in a situation where you have high value goods, it feels like that is what this is all going to come to.
Yeah, and the smart trailers.
Label?
So you would be aware if the weight changed on the load, or you would be aware if the doors were removed. Not just the seal was broken. I'm sure if the doors were removed.
Is there been some intermittent disruption? And it feels like certain commodities are more attractive for that. So you got the shipping label combined with the smart trailer system that connects to the airway system. Airway is sort of the OG of that, where it weighs the trailer in transit. That would tell you a lot about it. And then you also have the door monitoring. You can determine what the doors have been on. But here's what strikes me as interesting is, in every single kind of fraud or crime that's in this space, in any space, is the criminals just get smarter.
Well, right. So who's to say they don't cut a hole in the roof and take something out and put something else that weighs about the same and weld it back, right?
I guess that could happen. That feels like a little bit more elaborate.
Totally. But I'm just saying, like, there will always be a work. Like, this will always be something that's continuing to evolve. The criminals will continue to evolve. And so those trying to prevent it will have to continue to
It's an arms race. I'm encouraged that there's prosecution happening. I mean, one of the reasons we get these stories every single day is because there is some kind of law enforcement that's busting these criminal syndicates, which we desperately need. Yep. So look, it's something we're going to continue to follow, and I imagine tomorrow we'll have another headline on some type of fraud. Don't know what it will be.
Unfortunately, I'm sure you are right. All right, well, with that, we should get to our first guest. We have Lakshman Achuthan, who is the co-founder of the Economic Cycle Research Institute, here to talk about the global industrial cycle. Welcome to the show. Thanks for being here.
Oh, thank you for having me. Thanks a lot for having me. Interesting conversation there, I must say.
Well, unfortunately, we have them every day. Like, it's funny, when we started FreightWaves, everyone's like, freight supply chains are boring. How do you create a business, a media and data business on supply chain? Because it seems boring. But dude, it is far from boring. There's a lot going on.
I won't name names, but I used to work at a place in my summer job when I was a kid. And, there are some guys who knew a guy, and deliveries were happening. And I feel a little bit of this story that you're talking about here. And it's as old as, I guess, shipping has been around. But it happens in new ways as the technology changes, right?
Well, it's now far more sophisticated because a lot of it is being perpetrated overseas. These cyber criminals have figured out, it used to be the Nigerian scam. We always get notification that there's $100 million from a Nigerian prince. But now it's because of AI, they're so much more effective. It's like you're just, it's a matter of time before you will be exposed. I mean, that's the reality.
Yeah, no, it's a bit of an arms race, but like you said, law enforcement is pretty good. I've been on that end of it too and seen what they've done, and they're in there fighting. So
well, they're not as good as they should be, and I don't think it's their fault. We had a fraud conference a couple of months ago. We had the FBI and federal government and FBI, and look, the reality is they don't have the resources to go after all of these crimes, and that's the problem.
Is too big. The
volume is big.
Yeah, I agree on that. Yeah, absolutely.
So,
but anyway,
let's talk about the economy. Let's talk about something a little bit more. I call it more interesting, but certainly maybe not as depressing as fraud and the fact that stuff keeps piling up. So
we talk about business coming in the door. That's what we want to talk about, more or less.
So what are you seeing right now that's sort of top of mind?
Well, I was really excited to talk with you because in looking at the macroeconomy, kind of the backbone, the bellwether cyclical component, which is where we do a lot of interesting research, is on the industrial sector, the goods sector. So trade and moving things around, moving goods, either wherever they are on the supply chain. They could be early on goods, middle of the supply chain, or right at the end before you give it to the consumer. That's all super cyclical. And depending on where you are in the supply chain, the cycle gets a little bigger or a little softer. And right now, you're still in this upturn that we called almost 2 years ago. It's been kind of moving to the upside. So you've had a little bit of the wind at your back. I think that's starting to get a little old now. And
you think that the recovery is actually slowing down?
Well, I think it's time to. In the words, we sometimes look for quotes of notable figures, and JFK once said, "The time to repair the roof is when the sun is shining." And so, I would say there's nothing right here. So far, so good. But there are clouds on the horizon. A slowdown in industrial activity, both in the U.S. and globally, because these are kind of linked up cycles internationally, is on the horizon. So it's a slowdown. It's not the end of the world. It could be annoying if you were anticipating more demand growth to accelerate. It's probably not going to do that. It's going to top out. And it's even more annoying when prices for like just running your business haven't eased yet. Those are still sticky into the upside. So if your demand growth is slowing a bit and your prices of delivering your business are still sticky, your margins get squeezed. Nobody likes that. I think we have to prepare for that in the coming quarters.
So what do you guys do differently than other macro forecasters? It seems like your index moves ahead of the PMI as a leading indicator of some of those. You called the upturn, significantly before it happened. So how do you look at this differently? What are the things you're taking into account?
Great question, and I just want to full disclosure, right? What ECRI, Economic Cycle Research Institute, what we do is I work with a lot of people on Wall Street. I have friends who are on Wall Street, but we're not really Wall Street people. We're not Wall Street research in that sense. We're an older, I would say, 3 generations old now at this point. I'm the 3rd generation of researchers who look at cycles, kind of the upswings and the downswings in business. And that's different from how a lot of macro forecasters you might hear about forecast. In their models, a lot of what they do in very sophisticated ways, including with AI and all these things, is they extrapolate trends. So if something has been happening for a bunch of days or weeks or months, the forecast is it'll keep happening. Now, often that's a perfectly fine forecast, unless you're at a cycle turning point when it's a really bad forecast and can hurt you. And so that's where we step in. Is every once in a while we raise our hand and we say, we're near a cycle turning point. And what I'm sharing today is that, I think that there's this growth that's been running up for well over a year, almost 2 years. It's topping out and it's going to decelerate. You'll still be growing, but you'll decelerate. And these indicators you asked about, they have we have so many leading indexes and they're quite interesting. I've been tracking them for decades now. And the Global Industrial Growth Long Leading Index, which we affectionately call the GIGLY, this leads global industrial activity by almost a year. So that we watch how that's doing, and if we see it turning down, and it has, then we look at our shorter leading indicators to see if they're starting to turn down, and they are starting to. And those indicators actually lead things like the Purchasing Managers Index or the PMI. And a lot of industry people will follow where the PMI is. And if the PMI comes in a little weaker, they go, maybe something's happening. And for us, if the PMI comes in a little weaker, we say, that's confirming what we thought was going to happen. So now we know it's here. We have a lot of conviction in any decisions that we might want to be a part of, which could be, basic business management decisions you would take to navigate a slowdown like we're describing. So it's not the end of the world. But it's something that you can navigate.
So I'd love for you to tell us what you're seeing right now, and more specifically, you've got these indicators that tell us the global economy is slowing, the industrial economy is slowing. What is the stuff that you're actually seeing?
Well, right now, so the Global Industrial Growth Long Leading Index went down. Then our leading manufacturing indexes globally have started to ease. Coming to the U.S., the leading manufacturing index for the manufacturing sector of the U.S. has started to ease, still growing, but it's starting to ease. It was growing quite nicely until a couple of months ago. And that anticipates the PMIs, which will, in our telling, start to top out and ease. So you might see a headline in the fall that says, the PMIs have come down a little bit. Maybe that means there's some easing. Having listened to this program, you could say, that ECRI guy said this might happen, and now it's here. Everybody else is speaking.
So here's what we see. I mean, the freight cycle is sort of its own cycle. It really was a dog. It was an absolute dog. I would use a more direct verb if I wasn't on Sirius XM, but it was absolutely a dog. Up until November this year, last year, it started to recover. We're starting to see recovery. The rail volume data. So the U.S. industrial goods market has been pretty abysmal up until November of last year. It seems what you're seeing is counter to what we are currently seeing. So there seems to be a pretty disconnect.
So the disconnect happens at every turning point. That's actually the most interesting time, is the disconnect that you're talking about, right? Because I really am talking about time. A long leader is seeing something on the horizon. A short leader sees it halfway closer. The coincident data, like you're describing right now, what the industry is feeling right now is coincident. That's what's happening right outside your window. That's not forward-looking.
But I don't know that I agree with you. And I'm not. You do this for a living,
please,
but
this is good.
My point is that freight cycles, if you follow Dow theory, but freight cycles lead the broader economy. We've seen a widening of in the PMI. We've seen widening of the sectors that are seeing the impact. The railroads are, this past month was the second largest rail freight index since 2008. I hear what you're saying, but we were in such an abysmal market. The idea that this is going to roll over, again, I'm talking about the domestic U.S. market. Tell me where I'm wrong.
No. So one of the things you just added in, which I just want to, it's not a bad thing, it's part of reality, is the magnitude of the cycle, right? So you were saying it was very abysmal, and we finally recovered, and it's finally gotten back to a better reading. Okay, I think that's what you said roughly.
Well,
right?
I'm looking at the volume data, and it's broadening. Like it was started off a couple of months ago, or you can go back to November, and it seemed to be very concentrated in what we'll call data center and defense-related production areas of the economy. Since then, at least the data suggests that
which is great. If it's broader, it's much better.
But look, it's going to be disappointing news to anybody if you're right, and I have no reason to suggest that you aren't correct, but this would be devastating news for anybody in freight, because we've only been enjoying this for 8 months now.
Well, I forget who said this, somebody smarter than me, but to be forewarned is to be forearmed, right? And to navigate this, I want to clarify something. I'm not talking about a collapse, right? I agree with you. Volumes are up. They're healthier. They're broader. That's great. Those are no dispute there at all, okay? What I'm saying is that the pace of the recovery is going to ease, and you're going to have a deceleration in the growth. Okay, so it doesn't mean you're not still growing.
But isn't that normal? From the bottom, you're naturally going to, as you see the significant rebound, the pace and the momentum naturally slows. Is that what we're hearing?
Well, naturally, in the sense that it eventually turns down, right? So let's say, for argument's sake, I think this is roughly true. Half of all slowdowns turn into kind of harder slowdowns. I'm not predicting that, but that's why you have to be wary of slowdowns. You have to pay attention to them. The other component, and I'm shifting gears here a little bit, but you've got volumes, which are at higher levels, and the pace of increase is slowing. That's what we've talked about so far. The prices, right, that you're paying for doing your business are staying up, and they're sticky a bit.
Yep.
Okay, so that combo of slower growth in the business while prices stay sticky, that's just a little tougher.
You're saying this is stagflation? Are we looking at stagflation is what you're warning about?
in the industry specifically, I think that you have to be looking in that direction. You have to say, what would I do under those circumstances to navigate it and not get hurt? I think that's a healthy thing to do. I also believe that some of that international activity slows a bit, and so people who are exposed to that component of it. This is not only happening in the U.S; it's also happening abroad. And the third kind of business management component of this, I just want to throw on the table, happy to discuss any angles or dive deeper into any pieces of this, is just that rates, interest rates, probably just don't ease that much, right? I know there's hope that there could be some calming down in interest rates. It feels like they're going to stay here or edge higher. And that's also, part of the cost of managing the business.
Yeah, for sure. How much is the energy? We've been tracking the crack spread. I know Julie is obsessed with this crack spread thing on diesel, and with what's happening in Russia with these refineries blowing up. We've had multiple guests talk about the price of diesel and what it's doing to the economy. Is that what's really, you think, contributing? Obviously, interest rates are higher, but ultimately the industrial sector needs energy. Is that one of the big triggers of this slowdown you're referring to?
No, I don't think it's the trigger, no, because the antecedents, the things that were starting this slowdown happened before those events. So those events may make it worse, but they're not the cause of it. And so let's say everything just disappeared and everything was fine, it doesn't mean that the slowdown would go away.
What is the
It's
cause?
very natural for there to be cycles, by the way, right? So the global cycle goes up and down. It doesn't mean something's wrong or something's bad. It's just that's the way it actually is. Sorry.
No, so what is the cause? What is actually indicating this turn and slowdown for you?
For growth?
Yeah, if you're saying that you think that the growth is going to slow, right, and begin to turn downwards, what is it that you think is the cause? What is it that you're seeing that indicates that?
Well, so now we're getting a little bit into leading indexes, right? Where it's very different than the way Wall Street would forecast. They might say there was a negative shock and therefore there's a slowdown. That's not how leading indexes work. The way leading indexes work is you have, let's say, 5 or 6 big drivers of the economy. It could be pent-up demand. It could be productivity gains, profits growth. It could be interest rates, inventories. These are all big drivers of growth, each one of these individually. The leading indexes combine all of those together objectively, without an opinion. No, it's not like I know someone who told me something secret. It's just that they're very objective, and objectively they've decelerated. It's very natural for that to happen in a capitalist economy. This is normal. And this all began peaking in our longer leading indicators almost a year ago, and has been coming down, and the shorter leading indicators are following suit. Now, what are the causes, so to speak? It could be higher interest rates. It could be demand has a lot of pent-up demand earlier has been met. It could be there was some over purchasing earlier. These are all potential stories that we could fit to events after the fact, and that's typically how these things are described. But the actual kind of risk moment or divergence, I would say, between the leading indexes and what you see on the ground outside your window, that's a really interesting moment, because to take a little bit of defensive posture in that moment, when the sun is shining, like repairing the roof when the sun is shining, if you take a little bit of that, if you do that, then it's actually very cheap to do it. It doesn't, you can make some adjustments in your business plans under nice circumstances where it doesn't.
But how much of this, I mean, if we're saying this is a year ago, then tariffs is it a tariff issue that's caused?
No. See, that's and the questions you're asking, right, from the freight and supply chain vantage point, right? That's where you're.
That's what our audience cares about. So
okay, I got to tell you, the same questions when I'm dealing with asset managers, being like, is it stocks, bonds, private equity? What am I buying? All these things all over the place. They're asking the same thing. And what's very interesting, and it's the opportunity, in fact, is that the cyclical dynamics turned before the tariffs, before the war, before Hormuz. Those are all headlines that are very difficult to look away from. And it's very natural to draw a straight line from them to activity. But what I've learned in my entire professional career is that the business cycle is bigger than that. And that's what's happening here. The cyclical, we just had a nice run. I mean, maybe it wasn't enough. You would have liked a better run. You were pointing out that we just were recovering from these earlier depths. But the cycle doesn't care, right? It's just like, hey, I'm topping out here. And
it was a dog. It was an absolute dog. And we do not like dogs. We want this freight surge to continue. You're spoiling the party here.
No.
You're telling us the party's going to end. The police are on the way. This is not good stuff.
I am not going that far. I'm saying, hey, if you play it cool and you don't mess up, you can have a second chapter.
We'll turn the music down. We'll hide the booze.
Yeah.
Police are on the way. Keep it quiet.
Keep it a quiet get together.
Invite our neighbors over for a drink so they don't call. Yes, we know what's happening. Anyways, we got to go. Appreciate you coming.
Thank you so much. We'll continue to watch.
Take.
Yeah.
Like, it's something to watch. I mean, look, it's a very counter view to what we've been talking about the last couple of months. So, I don't know. What do you think? The police are on the way? Or do you think that the party continues? I think the music continues. It's my personal opinion.
Yeah, I mean, I think that the incredible high peak that we saw that was so volatile and happened so quickly, I think we're past that. And I think that there will be sort of more of a normal leveling out, a wider arc.
Global, not necessarily domestic market.
Yeah, and I think there are a lot of factors that U.S. manufacturing is having a resurgence in data centers and all of those things that kind of sort of play into just the U.S. versus maybe the global economy.
We'll have to have him back and spot check. We'll see if we get it right.
We'll be right back after this break with Sonar Update.
The drivers, dispatchers, mechanics, and crews who keep the world moving deserve tools that work as hard as they do. That's what Samsara builds, technology for safer, more efficient operations, made with the people who do the work. Samsara, built with operators for operators. Learn more at samsara.com.
The world doesn't wait, so neither do they. Wheels on the interstate, boots on the site, hands on the shipment. We build for the world out here, and we build it with the people who live it. Ideas from the field, made real by world-class R&D to keep the operation sharp, the front lines safe, and the world moving. From one cab to a global network, billions of miles, trillions of data points, every one making your operation better. And we never build it alone. Samsara, built with operators.
Once a year, the entire freight industry stops what it's doing and comes to one place, Chattanooga, Tennessee. This is F3. the Future of Freight Festival. It isn't just a conference. It's the largest festival in freight, built to pull you all the way in. The energy, the ideas, the atmosphere, and the people who move this industry forward. Over 50 speakers, 4 events across 3 days, founders, executives, innovators, and disruptors, all under one roof, all asking the same question: what comes next? On the main stage, the sharpest minds in freight take on the biggest questions in the business, the trends, the technology, and the forces shaping what's ahead. Then the clock starts, 7 minutes, no exceptions. The cutting edge of freight tech goes head to head, live, battling for best in show. When the time's up, the lights go out. And in between, the conversations that don't happen anywhere else, the connections that change the trajectory of your business, the relationships you'll carry long after you leave. Because when the sessions end, the festival begins. Live entertainment, unforgettable experiences, a celebration of the world of freight, and an energy you won't find at any other event in the industry. The leaders you need, the access you won't get anywhere else. This is where knowledge is shared, where deals get done, where the future of freight gets decided. F3, Future of Freight Festival, October 27th and 28th. The Signal, Chattanooga, Tennessee. We'll see you there. Register now at live.freightwaves.com.
Welcome back to FreightWaves Today. I don't know, Julie. You think this is a spoil the party time? I don't know. We're going to find out from our next guest. We have Jared Weisfeld. He is the Chief Strategy Officer of RXOs, coming to us from Greenwich, Connecticut. Jared, is the party over with, or do we have more time on the clock?
Great to see you, Craig. Hey, Julie, how are you? I think it's an aggressive call to say the party's over, considering we're coming out of a almost 4-year freight downturn.
Right.
But I also want to put things in perspective that we look through and we look to the long term. And from our standpoint, we actually believe that we're setting up for a multi-year recovery in freight. When you think about just how much capacity's come out, and you guys have talked about this extensively, and I think you've been spot on. But just to put it in perspective, I mean, we think as much as 20 to 25% of the for-hire truckload market is likely to come out from a supply perspective, and that's not a trivial amount. So what we've seen year to date has absolutely been a supply-driven recovery. So I think it's really important to point out that even though we've seen improvements in the industrial sector year to date with the ISM in expansionary territory all year, we're still talking about what is still a subdued freight environment from a demand standpoint. This has been primarily supply driven.
Well, I don't think there's anyone that disagrees on that. Yesterday, we had a really interesting conversation with Ken Adamo, formerly with DAT, now at East Logistics, and Jason Miller, a professor of supply chain at Michigan State. And they were making the case that they believe the cycle is going to be short-lived, or at least is going to roll over sometime in the next year, largely due to capacity expansion. I think Dr. Miller is making the case that drivers, fleets always overcorrect. I think Ken Adamo believes that the government's going to is going to ease some of the regulatory crackdowns due to pressure from the shipper community. But you're talking about something completely different. You're talking about the fact that it's going the opposite direction than what they're referring to. A 20 to 25% crackdown is a massive and substantial correction. Tell us a little bit why you think that's the case.
Yeah, our view is that recent government enforcement action is here to stay. And at the end of the day, the enforcement action is taken from the standpoint of improving the safety of our roads, decreasing theft on our roads, which we certainly support. So when we think about the actions that have occurred between non-domiciled CDLs, English language proficiency, the CDL mill crackdown, ELDs, everything from a cabotage standpoint, these have been ongoing for about 12 months now. And our view is that this is structural in nature, and it's the largest structural change to occur in the market since deregulation in 1980. So to your point, it's a different view. I think we've seen, if you look at year to date, the fact that spot rates, depending on the week that you're talking about, are up anywhere between 30 and 50% year over year, despite muted demand, speaks to how much capacity has come out. And I think there is more capacity that will continue to come out on a go forward or prospective basis. And then there will be a supply response at some point, to be clear. But we think it's going to be a rational supply response, not shadow capacity that's operating at unsustainable unit economics.
Jared, we agree. I mean, go ahead.
And I think another thing, that I read, and I want to talk more about what you saw on the curve in Q2 was that while rates did go up, they're really not as high. They're in line with the last peak, whereas the cost to operate a truck is up 26%. So I think that that's another indicator that we aren't done yet if we're going to be able to operate safely and profitably.
I mean, we've interviewed,
companies.
70, 80 CEOs and certainly as many C-level executives on FreightWaves today across this industry, lots of freight. And even the largest asset carriers, we consistently hear that they're not adding trucks because they can't find drivers. They would like to add, but they can't. And so, Jared, it seems consistent
and costs
with what
are rising.
you're saying.
Even if rates are rising, costs have also risen, and
yes.
they
want to
recouped
return capital
for the last 3-4 years.
Those are such great points. I mean, number one, if you look at the capital investments that are occurring right now on behalf of the asset-based carriers, we think that is more replacement than anything else in terms of just the fleet. So very much agree in terms of the issue is, are there actual bodies to go into the trucks as you think about just the current supply-demand balance? And the reality is, right, I mean, you talk about where, and Julie, it's such a great point, you look at from a few years ago, even though all-in rates, including fuel, eclipsed or were in parity with where we were in the first half of 2022, the operating costs were up, we'll call it 26%. You think about insurance, tires, maintenance, these are all going higher and they're structural in nature. And ultimately, the industry needs to it needs to deal with those higher operating costs, and it will come in the form of higher rates over time.
Yeah, I think that's another indicator that we aren't done yet. We can't be done yet.
I don't think we're done. I think this is a super cycle. But Jared, I do wonder, Julie and I both come from the asset side of the world. You guys have a pedigree as part of XPO and, and understand probably the best capital allocator in the entire history of the industry is the person that helped found your business. Do you think the reason that a lot of the sort of prognostication about cycles and the fact that this is going to be short-lived, do you think a lot of that has to do with the fact that the perspective is not from people who are allocating capital? They don't understand the need to return capital. Do you think it's driving some of this, or do you think it's just we're so burned so often that we have gotten it wrong during the recovery and these multiple sort of head fakes that's driving some of it? It just feels like what you're talking about, what we've been talking about, is kind of we're out of sync with some of the other parties around the table.
I think the framework in which we need to evaluate cycles needs to fundamentally change when you have a capacity situation that has structurally changed in a way that we haven't really seen in 50 years. So prior cycle analysis, while interesting, may not be completely relevant in the context of a population pool that is structurally lower given recent government actions. So I think that is guiding principle that needs to really be put in perspective. And our view is we're setting up for a multi-year recovery, and the next downturn, whenever it's likely to happen, by definition is likely to be more shallow than what we've seen, not to mention the fact that cost of capital, which we haven't talked about, is just so much higher than the prior cycle. So we think about the ability to invest in new fleets, the ability to start a new brokerage, to start a new carrier. When you look at where the 30-year is right now, and you look at where mortgage rates are at almost 7%, just becomes very difficult in terms of barriers to entry in the industry.
I agree with all of this. I think that people are looking at precedent and what has happened in the past and how framework was, but there's been a fundamental change
I think
regulation
what's being missed in
and
this,
new risks.
We talked about it yesterday briefly, was the fact that anytime an industry goes from very low regulation, there's like this pendulum of deregulation that happens all across every industry, the banking regulations that we saw, and then some crisis happens. And there's a massive pendulum swing towards more regulation. And I think that's where trucking really is. And frankly, a lot of folks have not seen a regulatory tightening cycle that's happened in trucking since deregulation. And it feels new and it feels unusual. So it's sort of surprising a lot of people. But Jared, I agree with everything you're saying. I find it hard to make the case that we're going to find if we see the government continue to crack down, and it's not just at the federal level, it's happened at the states too, then where are all these truck drivers going to come from? And I don't see how we're going to discover a new batch of drivers.
No, that's exactly right. And I think it's also important to put in context relative to what your prior guest was saying, even if he's right in terms of potential slowdown in certain sectors of the economy, like the industrial, right? From a freight economy standpoint, it's not just about aggregate demand. It's about where that demand is intersecting supply on that curve. And I think year to date has been a great proxy for that because let's be clear, everything we've seen year to date has been very soft from a demand standpoint. You look at overall shipment data, still down year over year every single month for the industry. RXO is outperforming that. We've got some idiosyncratic levers that have been fueling that growth. But the industry is still soft from a demand standpoint. But because so much capacity has come out, despite that, we're still dealing with, and I was looking even on Sonar data this morning, I mean, even though it's come down versus, call it July 4th highs, industry tender rejections are still at 13%, multi-year highs. And it just speaks to the fact that we're still in a tighter market than we've been in over the last few years. And it's not because of demand, it's because of supply.
Yeah, no, I agree with everything you're saying. I mean, you look here at the data, 13.5% is where we're trending above. And but you have what they're called normal seasonality, just at a much elevated level. And it's interesting because there have been some folks, X is such a cesspool of opinion in some ways, even though I am a prolific X user. The reality is that a lot of people have gotten nervous about the lack of momentum in the market, and they're like, "Oh, this is down." I think we're just so burned from the brutality of the Great Freight Recession that it's hard to believe that this could go on longer. And I think it's driving a lot of the sort of, the cheap seat paranoia that's out there.
Well, I think you also got to be careful. I mean, to your point, July and the early part of August are notoriously soft just from a seasonality perspective. I mean, you look at any given month in the calendar year, I mean, I think January and February and July are the 10th, 11th, and 12th best freight month of the year, right? So put things in perspective, right? It's seasonally weak.
We used to always say, now January is different because of sort of returns and gift card season that's changed January, but it used to be, you lost money in trucking in January and February, and then you sort of broke even in July, and then the rest of the months were there. It's sort of shifted now where July and August are kind of pretty weak. I think it's always been historically weak, but feels like it's even weaker relative to what it's been, a lot of because supply chains are more orderly than they used to be, where companies would plan, and particularly Intermodal, take advantage of cheaper freight to move a lot of that freight. What do you think in terms of the second half, in terms of peak season? We have different opinions on here about whether there's going to be a super strong peak season or whether it's a lot of the inventory is already moving across the country, and therefore it's not going to be as much peak. What are you thinking? Did we lose Jared? I think he
Seems like
I think he
an
froze.
internet issue on his.
Do you hear me now?
He's back. We're
You're
back.
Yes.
We're back.
Yes, we got you.
Can you hear me?
Yep.
Okay, great. So from a peak season standpoint, I'd say it's too early to tell, but we do think that the market is going to tighten between now and the end of September. That ultimately we are dealing with soft seasonality right now, but that is, to the earlier point, that is what we see all the time in the month of July and August, and our expectation is that we tighten between now and the end of September, and then from September through the end of Q4, I think it's really going to be a function of whether or not the consumer shows up. We haven't had a peak season in 4 years, so I think it's still too early to tell whether or not we'll have one this year, but our expectation is certainly that we're going to go ahead and tighten from a capacity and demand standpoint between now and the end of Q3.
What are your shipper customers asking for? I mean, we're hearing that they're coming in early or, planning earlier than they typically have planned. What are you hearing right now? What are you guys seeing?
I will say the most interesting thing that we're hearing from shippers right now is that shippers want to be doing business with large-scale providers of transportation. In the context of everything we've been talking about here today, Greg and Julie, with respect to federal enforcement actions, et cetera, are they dealing with a carrier, with a large-scale broker like an RXO that has the ability to go ahead and have the best technology that's out there, the ability to source capacity? We've got 120,000 plus carriers, the ability to go ahead and do that in a way with best-in-class vetting from a carrier standpoint, best-in-class safety metrics, And that is palpable in terms of recent conversations with shippers, in terms of ultimately consolidating the amount of freight that they are moving with large brokers like an RXO. I think that is single-handedly the largest or the most prevalent theme that we're hearing from our customers right now. And I think it's also in the context of the current market that we're thinking about. I think shippers want to make sure that they are prepared to the extent that there is a peak season. The market is very fragile right now from a supply and demand standpoint. And any movement in demand could go ahead and alter that balance. So preparing for routing guide failures, et cetera.
It's interesting talking to the large freight brokers because we're getting differing opinions about sort of what people are sort of this new environment post Montgomery, post SCOTUS. There's just a lot of sort of different opinions. And frankly, I'm always, I wouldn't say confused by it, but there just seems to be a lot of sort of differing opinion. But it does strike me that the larger companies are in a much better position to navigate this stuff than the smaller providers. How much are shippers leaning into diligence? You guys are public. That is both, it can be painful being a public officer because you got to answer to shareholders every quarter. But I imagine in an environment where shippers are really, really gun shy on whom they're doing business with and really validating that they have a trusted provider, I got to imagine that that is an enormous advantage right now.
It is a huge strategic advantage. And we love being public. We love reporting the success that we've had over the last 4 years after spinning out from XPO and the transformative acquisition that we had with Coyote. They were now the third largest provider of brokered transportation in North America. And that is Craig, you are spot on. It is an enormous strategic advantage having access to such a huge carrier base, having access to a strong balance sheet with significant liquidity, with the ability to go ahead and leverage our technology. We spend so much a year on technology, on leading edge AI, and doing that all with a best-in-class safety rating and carrier compliance program. In today's world, post-Montgomery, that is a huge strategic advantage. And when we think about the composition of the brokerage market, right now about the top 10 brokers represent about half the market. We think longer term, that's going to be, maybe top 5 represent, more than half. So we think about the ability for the industry to consolidate longer term, organically and inorganically. And we think that ultimately shippers are going to help facilitate that consolidation because they are going to want to do business with the larger brokers.
Yeah, I agree with that. I mean, I would certainly be hedging my bets, I guess, as to say, and ensuring that I am partnered with people who can stand up with me, right?
Do you think you would have cared 3 years ago as much? I don't think so.
No.
Because why would? I mean, 3 years ago, why would it matter?
If you're a large public shipper, you're worried about your name being
reputation risk,
right? But that's it. Now you're
worried about the company continuing to. I mean, you don't want your freight stranded, and you don't want it. And so I don't know. It feels like if I'm. I was in financial services, and we went through the ringer, and we would get to the CFO, and we were we're a small company. You get to the CFO, and he's got to choose between Bank of America, Wells Fargo, and this tiny company called TransGuard, who had a great product. We would always get knocked out because they buy the parties that they trust. They can look through the financial statements, being a public company, that they just, no matter how much value we described, it didn't matter when it came to a CFO. They wanted to know that the company was going to be around.
And by the way, Craig, we're having those C-suite conversations precisely because of that. We're ultimately, let's educate the shipper community in terms of what's happening right now in the current market environment and why doing business with someone like RXO is a strategic advantage for that shipper. You think about just the durability of RXO throughout market cycles and the access to capacity that we have, the access to resources and investments that we have. To your earlier point, it's a huge strategic advantage in this environment. And I think it's only going to become increasingly strategic because ultimately, I think these structural changes are here to stay, and it's going to certainly benefit the largest carriers and largest brokers.
So Jared, speaking of the access to resources you all have, so we obviously track spot rates. You guys report on it in your curve as well, and they have been significantly higher than contract rates all year, every month. So what are you seeing as far as routing guide breakdowns, and then how is RXO helping cover that spot freight for shippers? And what resources do you all use to do that? And then I have a follow-up also, actually, but I'll pause there.
Sure. In Q2, we saw, based on our RXO curve data, spot was at an average premium relative to contract at about 20%. Everything we've been talking about for the last 20 minutes or so, you've seen industry-wide line haul spot rates come in a little bit over the last few weeks. So that's probably at around, call it a mid-teens premium right now. And ultimately, what did that lead to in the overall industry? I mean, I think your own tender rejections from a Sonar standpoint reached as high as 17 to 18% around July 4th. You started to see routing guide failures for the industry. At RXO, how we think about where we are in this cycle, we need to service our freight incredibly well. So our industry acceptance levels were high. Our acceptance levels were high relative to industry. We had, so we continue to maintain those strong relationships. And, our view also is you don't win the spot volumes unless you maintain those strong contract customer relationships. So we actually saw a significant increase in Q2 on our spots, our special projects, our mini bids, to the extent that our Q2 spot volume was up 900 basis points sequentially, 1,500 basis points year over year, to about 42% of the mix. That further increased in July to about 50% of the mix, where we are proving to be the broker of choice in the community with respect to spot loads, projects, and mini bids, because we are servicing that freight so exceptionally well, and we are staffed for growth. We've got the resources to go ahead and handle that spot freight. And we're also investing aggressively in technology and leveraging tools to capture all of that volume. So we are positioned incredibly well to make sure that we're capturing that spot freight.
Well, and that was reflected in your earnings, right? When you talk about the spot to contract percentages. One further question on that. As we look towards peak, what would you advise shippers to be thinking about their contract versus spot mix?
I think shippers should be making sure that they are preparing for any type of environment whereby, to the extent that there is any improvement in consumer demand, that they are that they've got the right carrier partners to help facilitate. Because at the end of the day, if they're, like we've talked about here, we've seen spot rates up 30 to 50% year over year despite muted demand. Any improvement in consumer demand could really go ahead and increase freight rate volatility. And shippers need to be prepared, because they're going to want that predictability and visibility that that comes with contract-related volume. So make sure that they've got the ability to partner with strategic carriers and brokers like an RXO, because ultimately, if you do start to see an improvement in demand, you can absolutely start to see an erosion in routing guides, and that could be problematic for their service levels. So making sure that they're forward-thinking and making sure that they're lining up the capacity necessary to the extent that there is a peak season.
And Jared, I know that you guys would love for Capacity Now sponsoring the segment for RXO to be there when an asset carrier can't deliver the trucks, when they are leaving the freight on the docks. You guys want to be the first call.
We want to be the first call, Craig, and we are the first call. And I think that our second quarter results showed that in terms of our 1,500 basis point improvement year over year in spot volume, and saw another 800 basis point improvement in the month of July alone to up 50% at 50% of the mix. So, and I think that goes and builds on what we talked about earlier. To win the spot volume in this kind of market, you need to make sure that you are servicing your contract freight exceptionally well, and you have those deep customer relationships so that you are that first call.
I always said I wanted to be the first last call, Julie. I didn't want to be the first call. I want to be the first last call. Like because I get
you want to be a little desperate. Yeah.
A little bit of desperation.
You want to be the first call out of desperation.
I don't want to be the guy on the first call. So anyways, Jared, appreciate your time. Thanks for coming in, and we got to get to Greenwich. Greenwich is a beautiful place.
You're welcome anytime, guys.
We should do it.
Feel free to come on up anytime. Appreciate it.
We'll go visit you guys. We'll visit your other companies, the XOs. We'll just do a full tour of the Brad Jacobs companies. What do you think, Julie?
Sounds fun to me.
We'll be right back with a Sonar market update. Stay with us.
Getting reliable capacity can be complicated. Let RXO make it simple. As the third largest provider of brokered transportation in North America, RXO has the scale, resources, and expertise to help you tackle any shipping challenge. From a last-minute spot load to a managed transportation solution, from LTL to intermodal, From trained logistics experts to AI-powered freight automations, RXO has you covered from the first mile to the last mile. Start shipping on easy mode with RXO and get a smart solution to move your freight. Learn more at rxo.com/capacity.
The world doesn't wait, so neither do they. Wheels on the interstate, boots on the site, hands on the shipment. We build for the world out here, and we build it with the people who live it. Ideas from the field, made real by world-class R&D to keep the operation sharp, the front lines safe, and the world moving. From one cab to a global network, billions of miles, trillions of data points, every one making your operation better. And we never build it alone. Samsara, built with operators.
Once a year, the entire freight industry stops what it's doing and comes to one place, Chattanooga, Tennessee. This is F3, the Future of Freight Festival. It isn't just a conference, it's the largest festival in freight, built to pull you all the way in. The energy, the ideas, the atmosphere, and the people who move this industry forward. Over 50 speakers, 4 events across 3 days, founders, executives, innovators, and disruptors, all under one roof, all asking the same question: what comes next? On the main stage, the sharpest minds in freight take on the biggest questions in the business, the trends, the technology, and the forces shaping what's ahead. Then the clock starts, 7 minutes, no exceptions. The cutting edge of freight tech goes head to head, live, battling for best in show. When the time's up, the lights go out. And in between, the conversations that don't happen anywhere else, the connections that change the trajectory of your business, the relationships you'll carry long after you leave. Because when the sessions end, the festival begins. Live entertainment, unforgettable experiences, a celebration of the world of freight, and an energy you won't find at any other event in the industry. The leaders you need, the access you won't get anywhere else. This is where knowledge is shared, where deals get done, where the future of freight gets decided. F3, Future of Freight Festival, October 27th and 28th. The Signal, Chattanooga, Tennessee. We'll see you there. Register now at live.freightwaves.com.
All right, Julie, it's been a great show so far, but I got to ask, we've had 2 different perspectives. We had one who believed that the cycle is rolling over. By the way, I still find it hard to believe that this recovery is going to go on very short. I mean, Jared said it best, that we had just started and it's a regulatory crackdown, and I think that's why tender rejections are on fire.
I think we heard it in tender rejections. I think we heard it in every earnings call. Every executive said we're in the early innings of this.
I agree with that.
We're just starting to reap the benefits of it.
We think our first guest was just, he was talking about the global economy. And I feel like
isn't going to pick up. But I don't think that brings capacity back into the market.
No, I think you've got this long-term cycle. Look, we're at 13.5%, is where we're at today. We're well above where we have been, certainly year over year. This is a soft season. I think Jared said it best, this is sort of a time of year when things are naturally soft. And look, we have a lot of opportunity for momentum going into the second half or going into September past Labor Day. Anything that you really are thinking about or watching?
No, I mean, I just think that we need to continue to, I think people are a little bit worried about this bit of a downtick, even though it is
But look at where we were.
And then I think you need to remember where we've been the last 3 years, and then you feel better about everything. Right.
I was not used to having nice things. It feels like a little bit of a party, maybe a little bit of a hangover, got a headache. we're going to go back and party again, right? Don't you think?
And I think the same with spot rates.
Spot rates follow tender rejections. We've seen this. Peaked, we're at 13.3. Remember, if we were here, go back a year ago. Look at where we were a year ago in that 240-ish range, 240, 250. We would have murdered for that, right?
Absolutely.
So why is everyone like not feeling?
It's all that point of reference.
Momentum,
when
right?
you walk out of the door, if we went outside tomorrow and it was 80 degrees, we'd be like, oh, this is beautiful. It's wonderful compared to
the heat index.
But if you went outside and it was 80 degrees on April 1st and it had been 65 the day before, you'd be like,
even
it's
45,
hot.
you'd be like, it's
oh my gosh, it's so hot. I think it's all that point of reference, right? We got
and I think
really spoiled for a little bit, and
I think we all wanted it to continue to go up. Right, we all wanted it to continue.
It's going to have to normalize. That doesn't mean it's going to fall, right?
Because point of reference, but to your point, there's nothing to really suggest that this market is capacity is not coming back. I mean, a 20 to 25%. We didn't get into deep with Jared, but a 20 to 25% change in capacity is massive.
That's the largest number I've heard on that.
But by the way, John Kingston, our energy reporter, who studied the commodity markets his whole life, has talked about it's the incremental barrel of oil that sets the price. And it's just like in trucking, it's the incremental. Travis Kalanick, to quote him, it's all about pricing, right? Strategy and transportation is all about pricing. And I think what we're seeing is that pricing is going to continue. Pricing will find a way. And so when you have a 20 to 25% reduction in capacity, if Jared's correct,
and a 26% increase in operating costs,
then you're going to see a massive inflationary market in rate and massive continuation of tender rejections happening. And it's inevitable at that level. People get caught up in the, hey, I'm reducing 20% capacity, therefore rates must go at 20%. No, it's not that simple. Because shippers will pay whatever.
Well, it's not cost
the price bears,
right? That's what. And I know I'm talking about trucking costs going up 26%. I am fully aware that a regular out one-way trucking is not cost-based, but I think some of the regulation is driving that carriers have to be profitable in order to be able to continue to invest in safety and following the regulation and hiring the right kind of drivers.
And I think in every industry where you have gone from a deregulatory environment to a regulated environment, when the pendulum starts to swing towards regulation, it doesn't stop because no one wants to go back to the free for all. They want to go back. They don't want to go back to anarchy. And you can describe the trucking conditions as anarchy. Well, over the last couple of years, we're now headed into more regulation. I feel like it's going to stay. I don't believe or subscribe to the argument that Ken Adamo made yesterday that this is somehow going to stop. I think it's going to stay. I think it's going to continue to consolidate. I think the regulations are real. They happen at the state level. They happen at the federal level. I met Derek Bars. We interviewed him in studio. He is hell bent on doing police enforcement on putting more regulations that are sustainable in this industry.
Yeah. All right, so let's talk a little bit about maritime. We can go through this sort of quickly, but really the story here is that ocean rates are rising.
Look at this.
So the blue line
7,300
is from China to the U.S. West Coast. The white line is to the East Coast. So you can see the
9,400 to the East Coast.
Massive increase in spot rates. But the reason I wanted to talk about this today,
by the way,
ocean spot rates.
These are TEUs, 20-foot equivalents.
And the reason that I wanted to bring this up is because I think this is another example, sort of like what we talked about yesterday, where context matters. The rest of the data that we can provide in Sonar beyond just the rate really explains the story of what's happening. So while these spot rates are up, demand is not. Volumes are not. So if you compare the IOTI China to the US, you can see that the volumes have not gone up.
Down 1%.
So demand is, like in the trucking market, demand is not what has driven this increase in
the ocean carriers. I think a couple of things are going to happen there. It's a very concentrated market. The top 10 carriers have 90% market share.
Yep.
They have done a number of blank sailings, which means they basically cancel voyages. They slow the ships. One of the classic things that they do is slow the sailing. So it's not being driven by volume, but it's being driven by the ocean containers have an enormous amount of pricing power. And like I've said this before, and I'll say it again, is no crisis left
Exactly.
untouched. They use the opportunities, whether we're talking Hormuz, whether we're talking the Suez, whether we're talking, all of the different things that happen around international ocean shipping. Container liners are always willing to take advantage of those opportunities with higher freight rates.
So while it's not fragmented like trucking, the supply side chaos is driving the pricing, like I feel like in the trucking market.
Well, you
can see demand's not up, rates are up. You zoom in and you look at it just the last month.
I wouldn't call it chaos.
There's a bit of chaos.
It's the opposite of chaos, Julie, in the sense that this is very orderly. The ocean container lines, if you go back into the 2016, when Hygiene failed and went under, spot rates were $800. The ocean container lines had no pricing power, none. They lost it, but what they realized is, hey, we shouldn't be fighting each other ruthlessly for market share. We should be trying to maintain price, and the profitability is followed, and that's exactly what we're saying. So I don't think it's chaos. I think for shippers, it may feel like chaos.
I think for shippers, it feels like chaos. And I think that they are going to your point, no crisis unused to raise rates. So they can speak to, so this is the last month where you can see inbound to the East Coast, inbound to the West Coast in demand, when you just really see
demand out of China down 6%.
Demand is down, but when you look at those rates just since early August into the West Coast, massive increase specifically into the West Coast.
Yeah, I mean, look, a lot of this is just, we have.
Part of it is ocean containers, the providers can do it. Part of it is there are some, we don't need to talk about rejection rates. There's some factors that are leading to this that they could take advantage of, right? There are this El Nino. The Pacific Ocean is warmer than usual, more typhoon activity than normal. The Atlantic is cooler, less hurricane activity, but it's also been very dry. So the Panama Canal is a little bit low. So they have all of these reasons to be able to raise rates.
But no crisis left untouched. Right. That's what the ocean container lines do. Crazy stat. If you go back, so everyone agrees that OPEC is a cartel. OPEC combined, this is before we saw the recent, the UAE and others sort of leave OPEC, control about 36% of global oil supplies. Enormous amount of pricing power. The ocean container lines, the top 10, control 90%. Here's the crazy stat. I always have said this, I'll say it again, is the ocean container lines are not subject to U.S. antitrust. So they can do, and they can coordinate schedules. That's entirely legal. And what they'll do, very much like OPEC, OPEC pulls barrels off the market to control price, or puts barrels on the market to allow for prices to come down. The same thing, the ocean container lines, they pull capacity out of the market, rates go up. So while they may not be collaborating on price, they're actually collaborating on capacity in ways that give them pricing power, and that is really important. And I think it's why you see U.S. consumers and U.S. businesses having to pay really high container rates.
Yep. So we don't have to, we can run through these, but the overall point, rejections, not super relevant. The percentages of what's being rejected is not high compared to prior years, even though these rates are going up. But we are seeing more port delays. They're blaming it on these weather and all of those things. And I always like to try to put something here to provide context beyond just what shows in Sonar. So Yangming came out with their earnings yesterday, and it really talks about a lot of the same things we just saw in the Sonar data, with those spot rates being up, an early peak season, firmer freight rates, and they even spoke
at
to
482%, which is why they like higher prices.
Well, of course they do.
And it's no longer about he who has the most ships win. It's who has the highest profitability. That's what investors want to see, and that's what they're doing. That's why we have these surging spot rates.
Absolutely. And then they're going to, no crisis averted, talk about all of the things: trade policy uncertainty, geopolitical disruption, the Red Sea, excess vessel supply. They are talking about how more capacity is going to be added than demand, they believe. They did state that in their earnings. And schedule reliability. So I think the bottom line here is that if I were a shipper and I was trying to plan for fourth quarter, I would expect some volatility, certainly in rates, but potentially in capacity as well.
We'll be right back with the CEO of Flock Freight. Stay with us.
At Saia, it's a yes isn't just an answer. It's how we're built, a way of working shaped by our people, our nationwide network, and over a century of know-how that keeps freight and business moving. From coast to coast and across borders, our full-service freight and logistics services turn yes into real solutions for real business challenges. Deadlines change, conditions shift. Saia is ready for it all. For every customer, every day, it's a yes.
The world doesn't wait, so neither do they. Wheels on the interstate, boots on the site, hands on the shipment. We build for the world out here, and we build it with the people who live it. Ideas from the field, made real by world-class R&D to keep the operation sharp, the front lines safe, and the world moving. From one cab to a global network, billions of miles, trillions of data points, every one making your operation better. And we never build it alone. Samsara, built with operators.
Once a year, the entire freight industry stops what it's doing and comes to one place, Chattanooga, Tennessee. This is F3, the Future of Freight Festival. It isn't just a conference. It's the largest festival in freight, built to pull you all the way in. The energy, the ideas, the atmosphere, and the people who move this industry forward. Over 50 speakers, 4 events across 3 days, founders, executives, innovators, and disruptors, all under one roof, all asking the same question: what comes next? On the main stage, the sharpest minds in freight take on the biggest questions in the business, the trends, the technology, and the forces shaping what's ahead. Then the clock starts. 7 minutes, no exceptions. The cutting edge of freight tech goes head to head, live, battling for best in show. When the time's up, the lights go out. And in between, the conversations that don't happen anywhere else. The connections that change the trajectory of your business. The relationships you'll carry long after you leave. Because when the sessions end, the festival begins. Live entertainment, unforgettable experiences, a celebration of the world of freight, and an energy you won't find at any other event in the industry. The leaders you need, the access you won't get anywhere else. This is where knowledge is shared, where deals get done, where the future of freight gets decided. F3, Future of Freight Festival, October 27th and 28th. The Signal, Chattanooga, Tennessee. We'll see you there. Register now at live.freightwaves.com.
Welcome back to FreightWaves Today. Julie, every time I see the F3 ad and I see dancing sky with a little dancing lizard, it gets me excited. It's just a couple months away.
F3 is coming up quickly. We've got a few events in the meantime.
Last week of October, it is here in Chattanooga. The fall weather football is going on. I can smell the burning leaves right now.
I really am. I couldn't sleep last night.
Is it fall?
No, because work is busy and I had a lot spinning in my head. Good stuff, just, you know, like how your brain doesn't shut off. And so inevitably I online shop scroll, and I just am so excited for fall when I started looking at fall clothes and like wearing sweaters and doing all of the things.
All day.
Oh, I'm ready. Fall is the best. It's also been disgustingly hot here, which makes me
Was it, by the way, real quick, was in Wisconsin?
No, fall was not, it's like 2 weeks long. Fall
4 seasons down here, huh?
Fall has become, summer there is glorious, right, in Wisconsin, but since I've lived here, fall has by far become my favorite season. I adore it, and it's a whole like 3 months, and the leaves are pretty for a long time, and there's an actual changing of the weather where it's crisp in the morning, nice during the day, crisp in the evening.
People who live in 2-season states, I think, really miss the best.
Yeah, I don't feel like you get fall or spring in the Midwest. Spring is just gray and a few weeks of nasty melt, and fall is very short as well. But here it is wonderful. Sitting on my screen porch.
I don't like spring because of the pollen, and we have a lot of that
here. Like
down here.
Everything is covered in green and yellow.
We don't have white snow, but we have yellow snow. But anyways, Patt Dillon is the CEO of Flock Freight. Pat, we're talking about the fall and what's happening. Any big plans for you guys at Flock Freight this fall?
Oh, hey, Craig. Hey, Julie. Thanks for having me on. Yeah, I mean, look, it's been a great year so far in 2026, quite the difference from where we've been the last couple of years in this freight market. And, we're expecting a big peak season and, it's trying to get as much time with our shippers and our carriers getting geared up for what we expect to be a pretty big fall for us.
So what is the sort of sentiment right now? I mean, the LTL carriers have done, the last quarter was pretty astounding. The amount of operating leverage they gained in this last quarter. Obviously, capacity is very tight. What are you guys seeing right now in terms of how shippers are thinking about peak?
Yeah, I mean, I think for us in our kind of core shipper market, we're seeing folks that are focused on how do I meet kind of budgets? How do I deal with this rising rate environment in the FTL market, but not lose velocity? Be able to still get the kind of service that we need, the kind of speed, especially as you start to think about these tight weeks and months as you head into the holiday shopping season. So, it's trying to balance all that. And I think you guys have called it out a couple of times on your show. It's been such a shipper-centric market over the last 2 or 3 years. And now, it's kind of maybe switched to more of a provider-centric market. So I think it's totally changed the paradox and people are looking for new solutions. So it's been a great environment for us and shared truckload, which has been kind of a pretty differentiated solution for a lot of our shippers.
Yeah, so I want to talk a little bit about that. For people who aren't familiar with it, explain what shared truckload is and why right now it's so important with spot rates being up so much this year and people not willing to deadhead or waste space when it's available on a trailer.
Yeah, I mean, the simplest way to describe shared truckload is sort of carpooling for freight. So, being able to ride share or carpool 2 shipments from 2 individual shippers on a full truckload and allowing us to do 2 pickups and 2 drops to share that trailer space. So essentially pay for the space you need and not have to, pay to ship a half full truck. And that's essentially what the entirety of what shared truckload is. So you can imagine over the last couple of years, there hasn't been a big kind of penalty cost for having a half full trailer. But as freight rates in the FTL market have really inflated, everybody's looking to kind of wring out utilization and be able to drive their cost basis lower. So when you think about what shared truckload can do by driving higher utilization while still maintaining FTL level service and velocity throughout your system, it really resonates with enterprise shippers all the way down to SMB shippers. So it's been a great market for us. And it's been, an interesting time in the market for sure.
So it certainly makes sense from an efficiency standpoint. With fraud being so rampant in our industry right now, adding additional pickup, adding an additional drop, breaking that seal, opening those doors an extra time, adding another really party into the mix of that load. How do you guys address that?
Yeah, I mean, boy, it's been a crazy market from a cargo theft and cargo security perspective. So, and we deal with some of, our customer base ranges from some of the largest shippers in the world that have been, targets for some of these very sophisticated fraud rings. So for us, it's making sure that we have, best in class tracking, carrier vetting, seal requirements, working with law enforcement. And, I think we're really proud of the track record that we've had. We've invested a lot all the way from cybersecurity, where a lot of this fraud emanates, all the way to kind of relationships with law enforcement to make sure that, we have the ability to respond when incidents do happen. And, knock on wood, because it becomes an increasingly sophisticated threat environment, we've been able to, perform with the best of them. We get measured against, all of the traditional FTL asset-based and non-asset-based carriers. And I think our track record stands up with that, all of them. But it's a constant battle, as I'm sure some of the guests that you've had on your show have articulated. It's an evolving threat environment.
What kind of savings are shippers actually seeing if they do this shared truckload versus just booking a standalone truckload?
Yeah, I mean, when you think about it, look, we're trying to go after that freight that's the kind of mid-sized freight. So somewhere between 10 to 40 linear feet. So you think about that freight that doesn't completely fill up a full truckload, but isn't kind of right in that sweet spot for LTL. And I think a lot of shippers are surprised at just how much of their freight that's kind of running through their FTL routing guide or on their spot board actually fits really into that sweet spot of shared truckload. And when they're able to do that, the savings range from kind of 30 to 40%, because you think about our ability to be able to offer a discount because you're sharing that trailer space with another shipper. So, the savings have been, it depends upon what your next best alternative is and whether you're thinking about taking stuff off of LTL and putting it into shared truckload or FTL and putting it onto shared truckload. But when you multiply it against hundreds of shipments for a given shipper, it can really add up to be hundreds of thousands or millions of dollars of savings on an annualized basis. And I think the thing that we're most proud of is that when we look at our enterprise shippers, the amount of money that they're able to save in year one only grows when you go into year 2, year 3 of these relationships. And that allows us to have very sticky relationships. It speaks to the strength of the service that we have with our customers and seeing that savings rate multiply across a bigger and bigger part of their network.
So, Pat, I got to ask, you came to Flock Freight from Too Simple.
Mm-hmm.
You were a Morgan Stanley investment banker before Too Simple. Obviously, Too Simple was not Too Simple. Anything but Too Simple. What are your thoughts on sort of the post-mortem on Too Simple? Can you share us any comments on that or thoughts?
Yeah, I mean, look, I'll say that the kind of autonomous technology, I think I'm a huge supporter of it. I think, what a lot of the folks in the space that were competitors to Too Simple that are still, kind of in operation and driving, I think it makes tons of sense, right? There is a need for efficiency and higher utilization throughout the space. I think you can go at it a couple of different ways. You can go at it through autonomous operation, which supplements human drivers. And then I think, what we're trying to do here at Flock Freight, which is allowing the assets that are in operation to be better utilized, driving that efficiency. They're just different sides of the coin on how to go about it. So while it was disappointing to see what happened with Too Simple, I think, the industry is going to continue to evolve. Maybe the pace isn't going at the speed that everybody may have expected at one point in time when it comes to AV, but it's going to be a major impact on the space. And I think it's definitely coming. It's sort of undeniable, the progress that we're seeing a lot of the AV companies make.
What do you think the timeline is for fully autonomous or door-to-door autonomous, I should say?
Oh, man. Well, look, I think if you just from what I can observe from my friends and contacts in the space, it's starting to really proliferate, particularly in Texas. So what some of the names like Aurora and Kodiak are doing, it's really impressive what they're able to do. And, don't count out Tesla and what Elon's able to do. I'm not sure if the semi is the highest priority for Tesla, but certainly the market's big. And that's one of the best things about freight is it's just sort of the backbone of the physical goods economy in the United States. And whether you think about it or not as a consumer or a business owner, it's, essential to everything we do. You guys do a great job of highlighting the importance of the industry here. And innovation is really paramount, right? We see this kind of $1 trillion logistics spend in the United States and the need for innovation, whether it be autonomous vehicles, kind of software as a service, the kind of stuff that whether it's visibility, and then what we're trying to do here at Flock Freight with shared truckload and what some of our peers in the brokerage space are trying to do to help us eliminate empty miles, eliminate empty trailer space. It's all essential to making this industry work a lot better.
So, Pat, there's been so much happening this year in terms of regulatory environment, crackdowns, the Montgomery judgment. I mean, you guys as a third-party intermediary are certainly having to navigate new things that you haven't had to navigate. How are you guys sort of positioning yourselves?
Yeah, I mean, look, I think I listened to Drew from RXO on your show in the last week or two and kind of talking about insurance towers and carrier vetting. And, from us, it's the same kind of thing. You have to have the scale and the sophistication to be sophisticated on which kind of carriers you use. And we're really proud of our carrier vetting and the amount of money and resources that we've put into that. You have to have the kind of track record to be able to get the kind of insurance coverage that you need. And we serve some of the largest shippers. So we have, what I would say is like a really strong insurance tower to protect us, to protect our shippers. And it's all based on track record and trust and making it important and making it an investment. So Well, I think we're all still trying to sort out like the fallout from the Montgomery decision and some of the cases that we've seen. It's not necessarily different than what we were expecting to happen. We knew there was going to be enhanced scrutiny on all different providers, including the intermediaries like us in the space. And it's critical for us to be able to show that we've got the financial wherewithal, we've got the processes in place, and we're doing the right thing. I mean, at the end of the day, it's about making sure that our roadways are safe, that we're choosing safe carrier. It's, first and foremost, the right thing to do, but it's also good business for us to make sure that we're choosing the right carriers and partnering with the carriers, and then, being a great source of revenue for our carrier partners too, and making sure that we are, living up to our end of the bargain and making sure that we're a great place for them to come and get their loads and to partner with us, and we're helping to optimize their networks too. So, my sense is that this will eventually get sorted out, and we'll see a more normalized market, but it's certainly been tumultuous over the last 6 months or so.
Yeah, I'm curious. I mean, it strikes me that there are, in this space of particularly intermediaries, some companies make all their money just by driving to the cheapest possible carrier. That arbitrage pricing is built into the business model, getting the biggest rip by finding the cheapest carrier out there they can find and charging the biggest rate they can get away with. That model feels like it's at an enormous amount of risk in this environment because of the fact that is exactly what the Montgomery decision is going to go and attack. That's where plaintiffs' attorneys are going to really make their money, is making that point. Your business model is different because you guys are essentially marrying up unused capacity between shippers and between shipments. Does that put you in a better position than perhaps a traditional freight broker that's just trying to get it on price arbitrage alone?
Yeah, I mean, look, we're going to have to sign you up to be a sales rep for Flock Freight.
I'm not. By the way, this isn't a paid segment. I'm just I'm thinking about all these conditions and who's winning, who's losing. It's a really interesting proposition, and I'm thinking you guys seem like a really well-positioned company relative to some of the traditional freight brokers.
Yeah, look, I mean, I think the point about shared truckload is that because you're able to put two shipments on board and you've got a bigger revenue base in every load, because while we can save, a significant amount of money for shipper A on their shipment and a significant amount of money for shipper B on their shipment, by putting those two shipments together and doing it well, where the points of origin and destination are well lined up, where the appointment times line up, and packaging that into a really good shared truckload, we actually intend to pay our motor carriers more than they would earn on a traditional one pick, one drop full truckload shipment. So it's the same kind of carrier base. Our core carrier is a full truckload carrier. We're looking to be able to make sure that the appointment times and the routing lines up where there's minimal out of route mileage, same amount of days out on the road. We don't want to have people having long layovers, et cetera. But the intent is to pay more, and it's not because we're necessarily that there's any underlying reason other than we want high quality carriers. We want to and know we need to pay them more for doing two pickups and two drop-offs in a shared truckload environment. And that's great because when you kind of attack underutilization and inefficiency, you create a lot of value. And we want to create value for the shippers. We want to create value for the motor carriers. And we think there's plenty to go around, which is always the interesting thing when you've got an innovation that isn't about trying to steal market share, doing the same thing as somebody else better. We're certainly very respectful of the traditional full truckload brokers, LTL brokers that are out there. They're great competitors. We're looking for our niche, which creates a lot of value for others. So having more revenue in the load allows us to pay more, allows us to pay for quality, and it allows us to build these really, really strong relationships. So I think it works on many fronts, including the point about carrier vetting and being able to pay for really high quality service and really for safe motor carriers to be our partners.
Julie, did you ever do shared truckload? Did you ever get involved in that?
No, we didn't. So that's really one of the things that I wanted
so much
to
money
ask.
In air freight, when I was working air freight, we would consolidate. I mean, in those days, I'm not saying Pat does this, but I did. We charged full truckload rates, but we put shipments on there. I was doing my job for the environment, just to be clear. got to save diesel, but we would marry them
I
up.
successfully loaded backhauls to put revenue.
I mean, you would have
something
a
that we're already
normal
getting paid
line
on,
haul
but
rate
no.
would say the $3,000 to the East Coast out of Dallas, and you're making $9,000 because you had three. I remember I made a lot of money doing it. Was air freight forwarders.
Yeah, I mean, it makes perfect sense. Okay, so speaking of that, a lot of people have tried to do this and have done it manually. I even remember early in my career being at a conference and a company got an innovation award for trying to do this. But nobody's really accomplished it at scale. So can you talk about how you're pooling and matching these loads and these shipments and some of the technology you use to do that?
Yeah, I mean, you guys are right. It's not a new idea to take partials and put them together and marry them up. And in fact, Oren Zaslansky, who's our founder and executive chairman, this was the kind of stuff he was doing. He's a lifelong freight entrepreneur. He had started an asset-based company, a small brokerage, freight forwarder, and he saw the opportunity to do this both when he was an asset-based carrier and he was only loaded half full but paid full price, and then being able to do it manually as a broker. But what we do at Flock Freight that's different is we've built the underlying data set and the technology kind of rooted in the vehicle routing problem, operations research. It's sort of a canonical problem in academia. And we've been able to operationalize that. And really it takes different forms. We have thousands of shipments that are partial shipments at any one point in time, and we're constantly re-optimizing across the set to have the lowest cost to move those shipments to shared truckload pools, but also the highest probability of executing those and being able to meet the service requirements. And then we have to be able to take the pricing risk, because we don't take a partial shipment, call around, figure out if we can pair it with another shipment. We have to make that bet instantaneously. And we need to do that, whether it's a spot API quote or being able to put shared truckload into a routing guide against, kind of traditional full truckload providers. Being able to make that judgment about how likely it is that this shipment is going to pool with another shipment, what's going to be the underlying cost if it pools or if it doesn't pool. These are all really difficult judgments. They require proprietary data, which we've collected over a decade of operations. And then it requires really precise kind of data science decisions to be able to figure out how we build and take this risk, because ultimately it's about managing risk, being able to be there and live up to our service requirements to our shippers, and be able to do it in a way that's economically responsible to our shareholders as well. So you guys nailed it. The big key is being able to do this at scale, being able to do this at velocity, and be able to do it with the same kind of service requirements that some of the world's largest, most sophisticated shippers expect from their asset-based and non-asset-based providers. We stand up in a quarterly business review against some of the biggest and best non-asset-based providers and are held to the same standards that they are for a traditional full truckload mode. So having that technology that we've invested over a decade in and put a lot of time and effort in, we're really, really proud of it. And the last point I'll make is we've got just an outstanding team. It's some of the best freight people, folks that have come from world-class brokerages and other companies in the space, and also some of the really world-class technologists, people that come from government research labs, academia, some of the best, biggest software and technology companies. And marrying that together in a single cohesive culture is the thing that I'm most proud of being, a member of this leadership team and being teammates with so many great flockers.
Julie, do you remember a company called Jevic?
No.
Publicly traded, load to ride.
It rings a bell, but I don't know the details.
Called the OG. I'm not taking away from Flock's innovation. Pat, do you know of Jevic?
No, I think I've heard you talk about it maybe once or twice.
It was a publicly traded company that did load to ride. It was basically shared truckload. It was sort of irregular consolidation of LTL shipments, but it didn't make it past the financial crisis, because I imagine when freight drive, this is pre-technology, like it's 2009. It was a sister company of Saia, part of a company called SES. Saia stayed, Jevic went away. But it was, it was doing a lot of the shared ride services back in the, late 2010s. It couldn't survive the financial crisis because volume dried up and their operating cost was so high. I imagine that, but this is pre-AI, pre-data.
I'm sure that, there's
I imagine
a lot
you guys are in a better position because of the, but I am curious, during the freight recession, how difficult was that for your business model?
think about it, every shipper is sitting there and they've got their traditional incumbent FTL providers who are giving them lower and lower rates that they haven't seen in a decade and giving them great service. As much as they can sit there and say, oh, the shared truckload thing, it really makes sense, but it's hard to make a switch. So we're really proud of our track record because we were able to grow and have a really nice growth rate, including in 2025 when not a lot of companies were growing, or at least companies in the brokerage space were growing. We were able to grow, but it's hard to make that switch. So it's been a real kind of sea change in 2026, where companies that always thought, this is an interesting idea, I'd like to get around to implementing it. Well, now is the time. So it's been, pretty remarkable to see the kind of trajectory that we've had, especially with some of the enterprise shippers that maybe didn't have the impetus to switch. Now there's a big impetus to figure out how you can put shared truckload. And at the end of the day, it's, you guys have called it out. Many people have tried to do shared truckload at scale, but we're really the only ones that have done it at scale, at velocity. And, getting shippers to change some of their processes, whether it's the TMS setup or their operational flows, to be able to have shared truckload as that third mode of freight transportation, where we kind of sit right in between LTL and FTL, and having that third column for shared truckload, that's really been the game changer for us. So we grinded our way out during the freight recession. It wasn't easy for us, as it wasn't for any other freight brokerage. But, it's definitely a new environment. And when you think about something that can save a shipper 20% or 30% on a shipment, that's really, really enticing and worth the investigation and some of the implementation in this environment that maybe was, a headwind to us in 2024 and 2025.
Pat, I know you're a CFO, so you can appreciate what I'm about to say, but I would imagine during the down cycle, the operating leverage worked against you, whereas right now, it is your best friend. You're making so much more money because of the operating leverage of this business. It's got to be brutal, I would imagine, when you depend on these partial shared truckloads during the down cycle, when they can get direct point-to-point truckload for $1 a mile, they're going to do that. I mean, that's the reality. Well, Pat, really appreciate it. Best of luck in the new role. We hope to have you back, and we'll bring you back as we talk about holiday peak season, which is coming up. Stay with us.
Thanks a lot, I appreciate it.
Doesn't wait, so neither do they. Wheels on the interstate, boots on the site, hands on the shipment. We build for the world out here, and we build it with the people who live it. Ideas from the field, made real by world-class R&D to keep the operation sharp, the front lines safe, and the world moving. From one cab to a global network, billions of miles, trillions of data points, every one making your operation better. And we never build it alone. Samsara, built with operators.
Once a year, the entire freight industry stops what it's doing and comes to one place, Chattanooga, Tennessee. This is F3, the Future of Freight Festival. It isn't just a conference. It's the largest festival in freight, built to pull you all the way in. The energy, the ideas, the atmosphere, and the people who move this industry forward. Over 50 speakers, 4 events across 3 days, founders, executives, innovators, and disruptors, all under one roof, all asking the same question: what comes next? On the main stage, the sharpest minds in freight take on the biggest questions in the business: the trends, the technology, technology, and the forces shaping what's ahead. Then the clock starts. 7 minutes, no exceptions. The cutting edge of freight tech goes head-to-head, live, battling for best in show. When the time's up, the lights go out. And in between, the conversations that don't happen anywhere else. The connections that change the trajectory of your business. The relationships you'll carry long after you leave. Because when the sessions end, the festival begins. Live entertainment, unforgettable experiences, a celebration of the world of freight, and an energy you won't find at any other event in the industry. The leaders you need, the access you won't get anywhere else. This is where knowledge is shared, where deals get done, where the future of freight gets decided. F3, Future of Freight Festival, October 27th and 28th. The Signal, Chattanooga, Tennessee. We'll see you there. Register now at live.freightwaves.com.
All right, welcome back to FreightWaves today. We have talked extensively about fraud, and we're going to get into this with our next guest because auto transportation of moving vehicles across the country is exactly what they do. They're part of Cox Automotive Central Dispatch. Welcome, Lainey Sibble. How are you today?
I'm doing great. Thanks for having me.
So we have done that every day. We talk about fraud, and obviously auto transportation is an area where the bad actors have also discovered. How are you guys helping your customers mitigate and deal with fraud?
Yeah, absolutely. Central Dispatch, I don't know how much the audience knows about Central Dispatch, but it is the largest auto transportation marketplace. So we are moving, we had over 20 million vehicles listed through the platform last year alone. So play a really major role within the automotive logistics space. We have a ongoing commitment to marketplace integrity. And really ensuring that the industry can continue to move vehicles safely and securely and confidently. So we're doing a lot in this space. One of the big things that we rolled out this year was biometric identity verification on our platform to get access to the platform. And the next phase of that is what we are calling secure vehicle transfer. And it's really about extending that same level of security to the vehicle release process, to that pickup point when the carrier shows up to take the vehicle.
So Lainey, I would describe you guys as a load board for auto transportation if people were to ask it. Do you agree with that definition?
So actually, over 25 years ago when Central Dispatch began, it began as a load board, really a digital platform for matchmaking between shippers and carriers. But that is not all that it is today by a long shot. It's a lot more than that. So we've been investing to really take Central Dispatch from that matchmaking site to a fully integrated transport marketplace. So providing all those tools to help shippers and carriers move the vehicle. So everything from pricing to dispatch tools to a carrier mobile app that provides tracking and an e-bill, and the list goes on. So we've really extended to be well beyond that load board.
So you guys, as part of Cox Automotive, is one of the largest automotive service technology companies out there, just a massive, extensive thing. How much of the volume for posting comes from other parts of the Cox Automotive enterprise?
So, Central Dispatch actually started outside of Cox Automotive. It was really first to the space in automotive logistics and bringing this digital matchmaking online, where it originally started. So, I would say a lot of that shipment volume was there even before Cox Automotive really entered into this space. But being a part of Cox Automotive enables us to extend even further into the ecosystem because we have that reach. We have those relationships across the entire ecosystem. We have the great data, of course, within Central Dispatch, but beyond that as well, that allows us to provide those valuable insights to our customers.
Lainey, can you tell us what sort of drove you guys to add this new feature of the secure vehicle transfer, and then actually walk us through the process of what happens all the way through the load from the time it's matched to pick up to delivery?
Absolutely. So the release process is a place within the auto logistics space that has remained largely manual. There's a lot of increased digitization that's happened across auto transport, but that pickup point has really continued to rely largely on paper, on phone calls, maybe disparate processes that some providers offer, but there was really no standard way to add a elevated level of security to that process. So because of that, it's a place that these bad actors have decided to try and exploit because they recognize there are those manual processes there. And then furthermore, I'd add that the shipper who is having that vehicle moved, whether it be a broker or a dealer or another commercial entity moving the vehicle, they're often not present at that pickup point. So they need a way to ensure that they are maintaining the control of who that vehicle is released to. So that was kind of some of the background of the why this space is so important. And then I think, to remark on your other question about how it works, it's really pretty simple. We wanted to keep it as simple as possible because we are asking for a change in process here. So what happens is the shipper who is moving the vehicle, and like I said, it can be a broker, it can be a dealer, it could be an auction or otherwise. They're going to authorize who can pick up that vehicle. And once they do that, the carrier who has been assigned to pick up the vehicle receives a digital credential, and they receive that credential in an app that they already use for other parts of their workflow. So I mentioned how we've been evolving into being that full transportation transactional marketplace with all those tools. Part of that is a carrier app that the carrier can use when they're picking up the vehicle to inspect the car. And so that digital credential goes right into that carrier's app that they're already using. It is revocable should the shipper change who they're assigning. It is not transferable, so they cannot screenshot it or forward it or send it to someone else. Only the shipper has control. And it is geofenced, so it only becomes accessible once they're within a radius of that pickup location. So once they arrive there, they're able to pull up that credential in the app. And then they scan that against an app that releasing location has as well. And it basically shows, yes, this is the authorized carrier to pick up this vehicle. It can be released. The whole process is designed to take about 90 seconds. So we're really trying to make that process as seamless and as efficient as we possibly can while also adding in that layer of security.
So, Lainey, I want to talk a little bit about theft. We've covered a number of stories. Shaquille O'Neal had his Range Rover stolen in transit, and then it was shipped. It was on a ship overseas. Ray J has had a car stolen. Chris Bryant. These things happen in transit. Where is this technology going to mitigate or prevent those in-transit thefts from taking place?
So I think there's a lot of places where we can add security and where we have been adding security. This is one of those places. We've been focusing up until this point a lot about the platform and accessing the platform and adding an elevated level of security. I mentioned the biometric identity verification. We've been providing our clients more and more tools that they can utilize themselves to add that layer of security. So we have things like a carrier scorecard that pops up right before a shipper decides to engage in business with a carrier, providing them really critical information about that other party. And then we have the mobile app I mentioned a few times, which actually has real-time tracking as part of that app that cannot be turned off. So when the carrier in the vehicle, there is automatic real-time tracking that is turned on, and that visibility is provided back to the shipper so they can see where their vehicle is from the time it's picked up to the time it's delivered. This secure vehicle transfer part, of course, is very focused on the actual release, but it's going to take all of these different solutions, these different pieces of technology and behavior change all working together to ensure that we can continue to ship vehicles safely.
Yeah, I think we're hearing that as really a theme across all of transportation fraud, that there's going to be some level of shared accountability and coordination and collaboration through the whole life cycle of a shipment. So wholeheartedly with what you're saying. Want to ask sort of a separate question about sort of available capacity for when you are matching these shippers with actual auto haulers. We've done a lot of stories lately about consolidation within auto hauler carriers. Is that the right way to
Jack
explain?
Cooper, I mean, biggest.
Are you seeing that? Can you tell us a little bit about your views on that, if you're feeling it when it comes to available capacity to haul cars?
Yeah, so there's of course been that consolidation you all have mentioned, and there still also is a really large population of those smaller carriers. We continue to see that on Central Dispatch and elsewhere. Continue to see new carriers entering the market that. Honestly, they are looking to stand up successful businesses, and they need tools like this secure vehicle transfer to help them stand out and help them protect themselves from any bad actors that are out there. So these tools, they help them as well. I think carriers overall are facing that pressure of added costs. And we see that within the automotive space as well. But we continue to see, like I said, that influx of new carriers and carrier capacity in the automotive space.
So, Lainey, I would love to understand, we always ask our guests about the state of the freight economy. You see a really interesting sort of section between auto and auto demand and consumer auto purchases, the resale used market. What are you guys seeing right now in terms of the auto market?
Yeah, our volumes are at an all-time high. So we continue to see a lot of vehicles moving throughout the ecosystem. I think some of that comes from a willingness to expand the geographical region that dealers and others are willing to explore when they're sourcing or selling vehicles. And so as that expansion continues, there's more and more demand for vehicle moves, regardless of whether there are more vehicles out there.
So do you think that would you call the auto economy or the parts of the economy that's driving the automotive thing strong? Is it moderated over the last couple of months? Like what is your outlook in terms of the auto market specifically?
I think it's strong. I think that there continues to be that strong demand, a lot of move volume out there. I think the area of challenge continues to be that pressure on the carrier side with rising costs and insurance and fuel, the additional regulation that I know you all see as well on the freight side. So those same pressures exist on the carrier side. But overall, I would say continues to be a very strong market.
And do you guys track spot rates? Is that something that customers can do inside your platform, or is it just bilateral? They're negotiating among themselves?
So we have a great AI-driven pricing tool that we launched a little over a year ago, I would say, that provides the predicted price for any given move. And we're able to provide that price because of the volume that we have on Central Dispatch, the access to all that data. And so we've translated it into those insights. So for any move, with a pickup, a drop location, specifics about that vehicle, because that matters so much in the automotive space, we're able to return, here is the predicted price of that move, as well as a range around that and the time to get it dispatched. So probably a bit differently than what you all look at, but provides a lot of value to our customers and the industry at large.
We'd love to get some of that index data. It's such an interesting section of the freight market. Cox is such an interesting business. A friend of ours, a friend of Freight, Andrew Davis is corp dev. I don't know if you know Andrew, Lainey.
I do, yeah.
Tell him I said hi. He was at T. Rowe Price doing the transportation investing, and now he's at Cox. So bringing some freight pedigree to the Cox family.
Yes, yes.
Well, Lainey, anything else that, in terms of like action items that folks should do if they're moving cars, anything that they should be thinking about in terms of ensuring that their car doesn't get stolen in transit?
Yeah, I mean, I think you all remarked on this, this recognition of it's going to take everyone playing their part. And I'll just reiterate that because I think it's so critically important. Specifically on the secure vehicle transfer piece, I mean, this is really about establishing a new standard for vehicle release that hasn't existed previously. The technology is great. I love the technology, but that is not what's going to make it successful alone. It's going to hinge on everyone doing their part and that behavior change so that we make sure the vehicle ends up in the right hands. So, we're committed to leading the way on this. We're building the technology. We're going to continue to focus on driving awareness, driving education. And our ask is really just for partnership across the board, so that together we can ensure that ongoing safe and secure transportation of vehicles.
Well, Lainey, appreciate coming down and joining us today from hot Atlanta. I'm sure it's hot down there. It's hot in Chattanooga.
Very hot.
We know all about that. The heat index. We're going to be in Atlanta on Thursday, Julie, broadcasting live from the College Football Hall of Fame.
Yeah.
So we're excited about that. Such a treat. It is college football season. But tomorrow, we have a treat. We have Tom Albrecht of Reliance Partners going to join us in studio. It's always a treat when Tom comes. A lot of provocative takes. And of course, it's my favorite day of the week. It's AAR volume data, and we get that information direct from Bill Stevens on FreightWaves Today, starting at noon. See you then.